In 1700, Britain was broke, not poorer but financially trapped. The government owed more money than its entire yearly income. Default would have destroyed the nation. This is where history twists sharply. Most empires collapse under debt. Britain did the opposite instead. It turned debt into power. A dangerous experiment began quietly. The nation was exhausted by wars. France's wars drained the treasury. Taxes triggered public anger. Forced loans destroyed royal credibility. Trust in monarchy collapsed rapidly. Financial collapse meant political chaos. Chaos meant loss of global power. Britain stood at the edge. Something radical had to change. Here enters a shocking solution. Borrow from ordinary citizens, not secretly but legally. Public debt became national policy. This was unthinkable then. Governments were expected to hoard gold. Debt symbolized weakness and failure. Britain redefined the narrative. Debt became a financial instrument. Government bonds were officially issued. Citizens loaned money voluntarily. Interest payments were guaranteed. Trust replaced royal force. Debt turned into structured confidence, but confidence needs enforcement. That role needed an institution. Enter the Bank of England, founded in 1694. Privately owned yet nationally essential, it funded government war expenses. In return, it managed public debt. This reduced default risk dramatically. Investors felt legally protected. For the first time ever, a government honored debt reliably. Britain gained instant credibility. Foreign investors paid attention. Capital flowed across borders. The economy stabilized rapidly, but another innovation followed closely. Ownership itself was redesigned. Joint stock companies emerged powerfully. Multiple investors shared business ownership. Risks stopped destroying single fortunes. Losses became mathematically distributed. Profits scaled beyond imagination. Shares represented partial ownership. Ownership could be transferred easily. Money gained unprecedented mobility. Markets formed naturally around demand. London coffee houses became trading floors. Merchants argued prices aggressively. Information moved markets instantly. Yes, rumors moved prices too. Human psychology entered finance. Sound familiar to modern markets. The London Stock Exchange evolved. Capital allocation became systematic. Projects received funding efficiently. Ships, factories, and colonies expanded. British influence spread globally. Finance powered imperial ambition, but power always invites excess. Speculation seduced impatient investors. Greed ignored economic fundamentals. Early bubbles quietly began forming. History always leaves warnings behind. Innovation without discipline creates collapse. Still, Britain adapted through crisis. Rules slowly strengthened institutions. Transparency improved market confidence. Trust again stabilized the system. Here lies the uncomfortable truth. Modern finance was born from crisis. Debt created stability, not chaos. Markets grew from human fear, and fear still drives markets today. Pause and think carefully. Money is not physical value. Money is organized belief systems, and belief can be engineered. By mid-18th century transformation completed, Britain controlled financial architecture globally. Money moved faster than armies. Markets funded power efficiently. The state no longer feared bankruptcy. Debt became a permanent tool. A controlled instrument of expansion. This shocked traditional thinkers deeply. Saving gold was old logic. Managing confidence was new logic. Britain mastered financial psychology. Investors believed systems would hold. That belief became self-reinforcing. Trust attracted even more capital. Capital strengthened institutions further. A powerful feedback loop formed. This is modern finance DNA. Central banks evolved from this. Government bonds became benchmarks. Interest rates guided economies. Markets priced future expectations. Time itself became tradable. This changed human decision-making. People planned decades ahead. Pensions, insurance, mortgages emerged. Risk was quantified mathematically. Uncertainty was partially domesticated, but never fully eliminated. Fear still lived underneath. Every boom carried hidden tension. Every innovation introduced new risk. Complexity increased fragility silently. Systems looked stable until stress, crashes became inevitable resets. This cycle never truly ended. 19th century proved it repeatedly. 20th century amplified everything. Today's markets are digital echoes. Algorithms replace coffeehouse rumors. But psychology remains identical. Greed accelerates price movements, fear triggers mass sell-offs, technology only speeds reactions. The core structure remains unchanged, public debt still funds governments, joint stock ownership still dominates, stock markets still price belief. Confidence still holds everything together. When confidence breaks, panic spreads. This is why crises feel sudden. They are belief collapses. Britain understood this centuries ago. It built shock absorbers early, central banking, fiscal coordination. Legal frameworks, market oversight. No system is crash-proof, but resilience reduces destruction. That is the real innovation, not money creation itself. But damage control mechanisms, here is the hard truth. Modern life depends on this. Your savings, retirement, job stability, all tied to financial confidence. Ignore history and repeat disasters. Understand history and manage risk. This channel decodes that history so you stay informed, not surprised. If this series changed perspective, like, share, and subscribe now. More financial truths coming next. Success created dangerous overconfidence. Britain believed systems were unbreakable. Money flowed faster than discipline. Investors chased returns aggressively. Risk management became an afterthought. This is where reality strikes hard. In 1720, speculation exploded. A single company changed history. The South Sea Company emerged suddenly. It promised impossible guaranteed profits. Debt conversion was its real business. Government debt moved into shares. People believed wealth was inevitable. Everyone wanted quick riches. Even politicians invested heavily. Even scientists joined speculation. Yes, Isaac Newton too. Markets stopped caring about value, prices rose without justification, crowds replaced rational analysis. Sound familiar to modern bubbles, fear of missing out dominated. Shares multiplied in price rapidly, paper wealth exploded overnight, reality arrived brutally and fast, confidence cracked suddenly, prices collapsed without warning, fortunes disappeared in days, families lost life savings. Trust in markets evaporated. The nation faced financial trauma. This could have ended everything. Many empires fall at this stage. Britain chose correction, not collapse. Parliament intervened aggressively. Corruption investigations exposed elites. New regulations restricted speculation. Transparency became political necessity. Markets slowly regained confidence. The lesson was painfully learned. Finance needs rules to survive. Unchecked belief becomes destruction. Britain refined institutional safeguards. Legal protections were strengthened. Disclosure became increasingly mandatory. Markets evolved with discipline. Then came another major shift. War returned to Europe again. Funding wars tested financial systems. Britain's model proved resilient. Debt funded armies efficiently. Taxes alone were no longer relied upon. Bond markets absorbed pressure smoothly. Confidence held during stress. France lacked similar infrastructure. Its system cracked repeatedly. Revolutions followed financial failure. Britain avoided that fate narrowly. Money stability preserved political order. Finance became national security. This connection still exists today. Economic collapse fuels unrest. Stable markets maintain power. Britain understood this deeply. It exported financial models globally. Colonies adopted British structures. Stock markets spread internationally. Banking norms became standardized. The modern financial world emerged, not from theory but crisis. Every crash refined the system. Pain created institutional intelligence. Here is the uncomfortable pattern. Markets grow through failure cycles. Each collapse teaches discipline. Each recovery increases complexity. We still follow this blueprint, even today during crashes. Pause and reflect honestly. Progress rarely feels comfortable. Finance evolves through fear, and fear keeps repeating.